Welcome to The Explainer. We're going to tackle a big question today. When a stock market hits a record high and then suddenly drops, should you be worried or should you see an opportunity? Because that is exactly what just went down in Japan. So on August 20th, 2025, after this incredible run-up, the Tokyo stock market just hit a wall. A wave of profit-taking washed over, and the main index, the Nikkei average, dropped by a pretty sharp 1.5%. You know what really made everyone sit up and take notice was the timing. This drop came just 2 days after the Nikkei had blasted through to a new all-time high. That kind of whiplash, going from an absolute peak to a sharp sell-off in 48 hours, it makes you ask, what on earth just happened? To figure out if this is the start of a real crash or maybe just a blip on the radar, we've got to look beyond Japan's borders. And believe it or not, that's where the real story begins. All right, let's get into it. To really understand this drop, we have to trace the chain of events that led to it. And the interesting thing is, this story didn't actually start in Tokyo at all. The main driver here was a ripple effect, and it started all the way over in the United States. See, the high-flying U.S. tech sector had a bit of a correction, which set off this wave of profit-taking. That wave then traveled across the Pacific, and it slammed right into Japanese semiconductor and tech stocks. And since those companies are such heavyweights in the index, when they went down, they dragged the whole market down with them. But, what about other usual suspects, like policy changes in China, or maybe a move by the Bank of Japan? Well, as you can see from this breakdown, they were pretty much non-factors. China's moves were totally expected, and the Bank of Japan was just watching from the sidelines. It really isolates the main cause, that shockwave from U.S. tech. And here's where it gets really interesting. This drop wasn't across the board. Instead, what we saw was a classic sector rotation. Money didn't just disappear, it moved. It flowed out of those riskier, high-growth tech stocks and into safer harbors, things like utilities and food companies. The steady businesses people turn to when things get a little choppy. So, if the shock came from overseas and investors were just shuffling their money around, well, that paints a much less scary picture than the headlines might suggest. In fact, most analysts used a very specific term to describe what happened, and it definitely wasn't crash.
Yeah, almost no one was calling this a crisis. Instead, you heard this one phrase over and over again, a healthy pullback. Now that language is important. It suggests this drop might not be a sign of weakness at all, but actually a natural part of a strong market.
So what exactly is a healthy pullback? Well, think of it like the market just taking a quick breather. After a really fast run-up, things can get a little overheated, right? A little too much speculation. A drop like this helps release some of that pressure and shakes out the short-term bets, which can build a stronger foundation for growth down the line. And that view just completely reframes the whole event, doesn't it? From this angle, the drop isn't a bad thing. It's actually a constructive, almost necessary function of the market. Kind of like a pressure release valve to stop a bigger problem from building up. Okay, so understanding the why is one thing. But the real question now is, what does this mean for the future, and what should we all be keeping an eye on? In the near term, all eyes are on a few key things. First up, the Jackson Hole Symposium in the U.S. A single word from a central banker there can move markets globally. Then we've got U.S. inflation and jobs data, which will give us a read on the American economy. And of course, everyone will be listening for any new signals from the Bank of Japan. Any one of these could be the spark for the market's next big move. So where do things go from here? Well, analysts basically see three possible paths. The most likely scenario, the base case, is that things kind of trade sideways for a while before climbing again toward the end of the year. But there's also an upside case if U.S. rates fall, and a downside risk if that U.S. tech correction gets any worse. With all that uncertainty on the horizon, we land on the most important question of all. What does this actually mean for you? Because how you should react to a day like this really, truly depends on your own personal strategy. At the end of the day, there is no single right answer. It's all about your timeline. A short-term trader might see a fun opportunity in all this volatility. A mid-term investor could see this as a chance to buy great companies on sale. And for a long-term investor, especially someone using an account like Japan's NISA program, a pullback like this is often seen as a golden opportunity to buy more at a better price. And that's really the key takeaway here. A 1.5% drop isn't just one universal event. To one person, it's a sell signal. To another, it's a buy signal. And to a third person, it's just noise that has zero impact on their long-term plan. The meaning of the signal depends entirely on who's listening. Which brings us right back to where we started.
In a strong market, is a sudden drop a reason to panic, or is it maybe just the price of admission for the gains that lie ahead? As we've seen today, the answer isn't really in the headlines, it's in how you choose to see it.